Hi and welcome to Reliance Expert Series. We have with us Mr. Amit Tripathi, CIO Fixed Income. It's always a great opportunity to understand the fixed income scenario from an investor's perspective. Welcome, Amit. So, sir, there have been talks about the rate hikes post the minutes of the RBI policy was released. So, what is your view on the same, and how do you think the RBI's actions are going to be in the near future?
So I think the RBI's minutes were a mixed bag in that sense, although there was one of the members who did talk about a preemptive rate hike. In equal measure, there were other members also who actually talked about the inflation trajectory might come out lower than what they are anticipating right now. But in general, one could be right in saying that the minutes were reasonably more hawkish than what the market had anticipated, and there was some reaction, although not very large, as a result of the relatively hawkish minutes as compared to market expectations. As far as our own expectations regarding future rate path is concerned, and I would actually not want to talk about rate hikes right now because that is not the base case scenario the way we look at it, for the simple reason that the RBI has literally zeroed down on inflation as being the primary criteria for them to decide on the future rate path. The reason they turned from accommodative to neutral was also to do with the fact that they believe that while growth momentum has bottomed out and has started picking up, it is really what might happen in terms of inflation that needs to keep them guarded. In our view, the three main points or the three main issues that the RBI is closely looking at. One is the cyclical upturn in commodity prices. Second is the impact of the 7th pay commission, especially the HRA portion of that. And third is GST. Bear in mind the fact that in the last 4 occasions, this headline and core CPI inflation has actually on a monthly basis been below what the consensus estimate was rather than above. May, June will continue to show an inflation trend where headline CPI will continue to be below 4%. A lot of that honestly has to do with the base effect, but core inflation will also remain steady. By July, we will know clearly as to what is the monsoon trajectory likely to be. That might give more comfort to the markets if we have a normal monsoon, as has been predicted by the authorities. All this plays out in the manner in which we are looking at it, and given the fact that GST ultimately may not be very inflationary from an India-centric point of view, one really does not look at any action either in terms of a hike or in terms of a cut over the next 6 to 12 months, or rather over the next 6 months at least, and one looks at a reasonably long period of time where the RBI will have a status quo in terms of policy. So we are right now not penciling in either a rate hike or a rate cut, at least in the next 6 to 7 months.
So, yields have risen during the past few months. So, how are the markets expected to behave, in the going forward?
The first reaction that the market had, or the first reasonably large reaction that the market had in terms of yields moving higher, was after the February policy of RBI, where the market was actually expecting a rate cut. The RBI did not deliver a rate cut, and in fact they changed their stance from accommodative to neutral, which also removed any reasonable probability of rate cuts in near future. So that was the time when we actually saw this main move upwards in terms of interest rates. Since then, rates had been maintaining a tight range till the time the April policy minutes were issued. This happened in the 3rd week of April. We have already discussed the minutes were more hawkish than what the market was expecting. You saw a further 10 basis point correction in yields after that. So as a result, your current 10-year benchmark, which is actually not the best barometer because that security is going out of favor. There will be a new issue in the next 1 or 2 weeks, but the new 10-year benchmark might most probably hover around the 680 kind of a mark to start with, 680, 685, which in a net basis is reasonably higher than where we were in December. So I think the major move has happened because of change in RBI stance, and the last 10 basis points is because of the April policy, although that is not the major driver for yields. Going forward, since we maintain a status quo in terms of, or since we anticipate a status quo in terms of RBI policy pronouncements, we do believe that markets will continue to remain in a range. The downside in terms of yields will be restricted because of RBI's policy stance and the fact that they continue to remain reasonably concerned about inflation. The upside will be capped for two reasons. One is very good liquidity conditions, which are likely to continue for some more time, along with fairly tepid credit growth. And second, the fact that actual inflation print may not be in a range which would cause any worries for the RBI. So on one hand, you have a watchful policy stance for the next 5 to 6 months. On the other hand, so on a net basis, we expect the markets to continue to remain in a range as far as government bonds are concerned. I told you the lower and upper bounds would be defined because of stance that the RBI has taken. The close was that they will keep on inflation, and at the same time you will have good liquidity conditions, and you will have the actual numbers of inflation prints helping the markets remain constructive over the next 6 months or so.
What are the key factors that one should watch in the next few months in fixed income markets?
So I think given the current policy stance of the RBI, as we mentioned, it's reasonably clear that we don't expect any kind of rate action happening near time. The fundamental factors which impact interest rates will continue to evolve. For example, the consumer price inflation print month on month will be something that the market will very closely look at, especially core inflation, how the monsoon progresses, what are the timelines for GST, and is there any impact that the market believes it can have in terms of inflation. Although, like I discussed earlier, in terms of market views, there are mixed views, and there is a school of thought which says that there will not be any meaningful impact as far as the inflation trajectory is concerned. So these fundamental factors is something that the market will continue to look at, other than just a rate cut or rate hike expectation. And most importantly, I think what will also support the markets going forward are very good liquidity conditions. Core liquidity conditions will remain to be in excess of 2 to 2.5 lakh crores for the foreseeable future. We are any which ways in a lean season as far as credit is concerned, and a credit to deposit ratio continues to remain very comfortable from a liquidity perspective. So liquidity will continue to support markets. The longer end will remain volatile, and hence most of the investors would continue to mostly want to put their incremental investments in a neutral duration kind of category, 2 to 5 years, for two simple reasons. One, this is the segment which would continue to benefit the most because of good liquidity conditions, and two, the curve here is also very steep, which basically means that as an investor you get a lot of protection from the curve itself, from any interest rate volatility, and more importantly, as you stay invested for the next 12, 18, 24 and 36 months, you get benefits of a roll down also from a steep yield curve. So this is the segment which clearly looks reasonable from a risk return perspective, at least near term. And as fundamental factors get more clarified, especially on the inflation side, investors will then take a more meaningful view in terms of how much allocation of duration needs to be there in the portfolio. As of now, we would suggest investors do a 75-25 kind of allocation, 75 being in the shorter duration accrual product kind of products, and 20 to 25% in long duration.
So SBI has cut deposit rates recently, and so our accrual strategy is going to be perfect right now for investors, or is that something else that they should look out for?
Along with SBI, most of the banks in the last 3 to 6 months have cut their deposit rates. Now clearly cost of deposits for banks is falling down, and banks are sitting on reasonable amount of liquidity, especially post demonetization, and that is why they don't want to have higher cost deposits, especially bulk higher cost deposits. And clearly in an environment where investors are looking for higher accrual on their savings, higher accrual on their investments, and their investment horizons are 1 to 3 years and beyond, it makes a lot of sense for investors to look at these accrual products. Not only do they give more attractive accruals vis-a-vis what traditional savings instruments like bank FDs are offering today, but more importantly, even from a risk reward perspective, because of the strong credit research capabilities that we have, because of our ability to access good quality debt instruments with attractive carry and invest them through our portfolios, investors will stand to benefit on a relative basis as well. And most importantly, in continuation with what we were discussing in the last question, these portfolios typically have a duration profile of 2 to 3 years, which also means that even if there is some amount of interest rate volatility going forward, investors who have a time horizon of 12 to 24 months and beyond will on a net basis not feel this interest rate volatility too much because of the neutral duration nature of these portfolios. So a combination of accrual and neutral duration, attractive accrual vis-a-vis the deposit rates will ensure that over a 1 to 3 year kind of a time frame, if investors are coming into these products, they will definitely stand to gain vis-a-vis what they are getting in bank FDs as well.
Thank you so much, Amit. It was a pleasure having you with us. I'm sure our investors have learned a lot from what you said today. Thank you so much, Amit. If you have any questions, you could write to us on our email ID, or you could also follow us on Twitter. The details of the same are mentioned on the screen below. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.